The dot plot thickens. You know, it should be evident, and much of your writing has focused on the notion that if you started to plot the dots and you look back at 2012, then were the low dots, whether it was to the neutral range or just general horsepower of the economy, those are now the high dots. So the lagging indicator nature makes many nervous. What are your thoughts?
So I think that's why Chair Powell wants to get out of the guidance game. You don't give guidance on something you're not sure about. It'll impair your credibility over time. You just see the cloud of dots drifting lower and lower. The lowest dot in April 2012 is now the highest dot in September 2018. That doesn't say a lot about your ability to understand the macroeconomy. If you don't know, don't say it.
Now, and this really does underscore, I can remember when Alan Greenspan started to tinker with the notion of guidance. They would have 3 choices, then they modify it, eventually we went to the statement, press conferences. I think it should be the dawning of a new age of guidance avoidance. You seem to agree, but easier said than done.
If you look back at the FOMC transcripts, the first thing any chairman says in front of a conversation about communications is we have to be completely unanimous, we have to be completely confident, because once we put something out there, we can never take it back. I think they've got a chance next year to do away with the dot plot. They're going to get the funds rate close to where they think is neutral. Chair Powell can go out and say, I'm not sure whether rates are going to rise or fall the next time, and maybe they can tell you where the long run is, but you know, the next couple years, that's over describing monetary policy.
All right, now let's get into the real heart of the issue today. I personally think, along with many, that Jay Powell's very pragmatic, and even though much of what he considers seems to be lagging or following the market, I think the notion of a pause is something they may see fit to comply with as we move through time. You don't quite feel that way. Tell me why.
So I understand the argument for pause, but I also understand at a practical level that once you stop, it's hard to restart. The headlines are going to be Fed's done. And what you've essentially done is put a bigger speed bump to the next action. If you think you're close to where the funds rate should be in the long run, get it to that level, maybe stop a little short, and then say, we're done. From here on, all decisions are data dependent and made meeting by meeting. Maybe we're more likely to raise the rate the next time than cut it, but we don't know. So if we're up to me,
here's the problem I have with that whole notion, Vincent, is that you say it's too hard to stop and start again. I say it's too hard to break the domestic, if not the global economy, of its addiction to liquidity. So maybe we need to do things that are uncomfortable. Your final thought, I would like to know, when do you think we're going to get to balance sheet exit with terms of reinvestment? Is that a 2019 or a 2020 in your opinion?
2020. They want a smaller balance sheet.